Well, hey there, everyone. Happy Monday, July 27th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful summer day here in Redmond, Washington. Hope you guys had a joyful weekend and are doing well today as we digest a very choppy session. Today was a weird one. I would say that's what the professionals would say. This is a weird day. Huge open, right? So the S&P close is up around 74.70, immediately starts rotating lower, right? So that strong open, you can see traders selling into that strength. By around 10:30 a.m., we're underwater for the day. And then the whole rest of the day, we're just kind of chopping around between 73.90, 73.40. End of the day, we ended up almost exactly where we started. The S&P was just a point away from Friday's close. So, certainly feels like the market is treading water and preparing for a fire hose of earnings, as it were. Some earnings starting today, but through the course of this week, we've got four of what we call Dave's Dirty Dozen reporting earnings. A lot of mega cap growth stocks reporting, a lot of other names reporting, a big percentage of the S&P. So there's going to be a lot of stocks to reflect on through the course of the day here. Quick shout out. We're actually today is Giving Day for a cause that I'm a big supporter of called the Walden School. This is a summer music camp that's based in New Hampshire. They have a young musicians program and an adult music camp that I've attended a couple times. It is a fantastic place where they teach young musicians how to be better musicians. And at a time when we are all feeling so separated and so fragmented, it is a beautiful community of wonderful people challenging each other, collaborating, and making music. We've got a link. We're got a link on our YouTube channel. If you're watching the live stream there, you're welcome to donate or go to marketmisbehavior.com/Walden to learn more about Giving Day, learn more about their programs. And if you feel so led to support them today on Giving Day, hey, I'd appreciate it. But thanks so much for checking them out. And if you know any young musicians, make sure you point them to the Walden School. It's a wonderful, wonderful place. All right. Let's get to the market here, and we'll talk about the market conditions and this choppy trading day. We will talk about the heat map, and you'll see that mega cap growth struggling a bit here as we again sort of prepare for earnings season. Then I've got some charts that I've hand selected. We're going to talk a little bit about breadth in particular. The Hindenburg Omen, by the way, fired on Friday. Didn't realize it till over the weekend. I was looking at the charts and I was like, oh, that happened. So we'll talk about that a little later and the implications of that signal that just continues to keep firing up for us. All right, here, looking at the S&P 500, you can see flat for the day. We closed today at 74.13. That's literally a point away from Friday's close. So choppy session, strong open, immediately sold off, ended the day kind of going nowhere. The Dow was the best performer on the front page here, only up about 0.5%. So at the end of the day, kind of a volatile session, but directionally, no real progress made at the end of the day. But worth noting that the Dow definitely outperforming the NASDAQ. Value over growth continues to be a theme that has really been in place through the month of July. But I would say today, yet again, mid caps and small caps did a little better than their large cap counterparts. Both the mid cap and small cap indexes at least finished in a position of strength going into the close. Transports and utilities both in the red. Volatility was pretty volatile, right? So the VIX opened below 18. It immediately surged higher. And as the S&P sold off in the morning, the VIX looked like it was going to get above 20. It didn't quite get there. It didn't quite reach 20, but definitely surged up to that point. By the end of the day, we're back down to an 18 handle, 18.7, which again is not far off of where we finished the week on Friday. So if you look at the last week on the VIX, we keep teasing that 20 level. And 20 for me is a classic kind of back of the envelope red flag. When I'm concerned about market conditions, which I would say I definitely am, meaning I could see the likelihood, a growing likelihood of some sort of meaningful correction beyond what we've seen so far. As long as the VIX remains below 20, that tells me to not be too concerned about it. VIX gets above 20, that's when we have to start to be worried. So we remain in a safe position. I think that's a good sign going into the close here. Rates generally move lower today. Last week we've been, and really in recent weeks, we've been tracking the push higher in interest rates. Bonds actually rallied a lot better than stocks today. So the 10-year yield drifting lower. Currently just below 465. The long bond yield's right above 5.1%. and the 5-year point around 4.4%. So the yield curve coming down a little bit, flattening just a little bit, still very much in a normal shape, and still certainly steepening over recent weeks and really recent months. Dollar pushing up slightly, but not too much to worry about. That dollar chart generally kind of trending in the upwards direction here in the last week or two. And I think that's a danger sign to be watching for as well. On the commodity page, a lot of red here, and we'll jump right to obviously the biggest shifts, which is in the energy space. Crude oil down 9.5% today. Brent crude down over 10%. Crude oil, which is the WTI Cushing, which is the U.S. benchmark, down to around $82 a barrel. That's coming down quite a bit from around $90 a barrel going into the weekend. Of course, news headlines over the weekend, and particularly yesterday on Sunday, implying sort of the latest ceasefire, or whatever we want to call the cessation of hostilities. Temporary for now, but crude oil prices taking a big drop in anticipation of further stability in the Middle East. So we saw crude oil prices surge as the conflict re-escalated. Implications that the conflict may cool off a bit. We're seeing crude oil prices go back down. So I'd mentioned if you love volatility, you're going to love the crude oil market right about now. So I think, crude oil in particularly a very volatile space. And I think these sorts of moves, unfortunately, are going to be the rule, not the exception, as we continue to get widely swinging headlines, right? From one day to the next. We're not getting like a things are okay kind of headline. It's either things are amazing or things are absolutely horrible, right? And we kind of go between extremes. As a result, crude oil prices are fluctuating pretty aggressively. Other parts of the energy space moving lower. You can see natural gas and gasoline futures also in the red. Soft commodities all in the red. I had a really good interview with Miss Schneider. That's the latest episode of the Market Misbehavior podcast. That actually came out, I think, first thing this morning. So make sure you check out our YouTube channel. 2 great interviews last week on the podcast. I'm really enjoying having some great conversations with people like Miss Schneider. Mish got her start trading ag futures, and so it's actually a lot of fun to talk to her about soft commodities, about the commodity space in general. We talked about metals, talked about silver, talked about a bunch of different things, and I really appreciated that. Also, Steve Kress, who runs the quant team at Seeking Alpha, was on the podcast last week as well. Both of those interviews highly recommend for sure. Soft commodities now coming off today. Chart of soybeans, chart of wheat have been fantastic recently. So both of those kind of giving back those recent gains. That, of course, is tied, Strait of Hormuz, food supply, fertilizer. It's all part of that same kind of Middle East, list of headlines. So when tensions are easing a bit, we're going to see crude oil prices. We're going to see soft commodities coming down pretty good. Cryptocurrency is kind of a choppy weekend. Bitcoin currently trading right around 65K. This is where we've been the last 24 hours or so. Ether prices just slightly below 2,000. All the top 10 coins are in the red today, but Ether in particular had a really good Sunday going into Monday's session and a nice rotation higher. So coming off of a fairly decent level. That 2,000 level on Ethereum, by the way, is one we're watching very closely. All right, looking at the sector breadth, we can see 7 out of the 11 S&P sectors finished in the green. Consumer staples, the top performing sector, that's up 1.5%. We've got some earnings in that sector this week. I grabbed a couple charts in consumer staples. I think Philip Morris, one of the tobacco names, breaking out today. Those have been some interesting charts here. Consumer discretionary, number 2, up 1.3%. So both the consumer sectors having a pretty decent start to the week. Communication services, number 3, up 1.3%. On the downside, energy, not surprisingly, given the fact that crude oil prices came right back down after the spike higher last week. The XLE down 2.1%, followed by utilities down 1.33%, technology down 0.9%, and that hurts, right? I mean, that it looks like only 4 of the S&P sectors are down, but on a market cap basis, that's a lot of market cap on the downside here with tech in the red. And so, some of the semiconductor names that have been some of the best performers Q1 to Q2 really struggling here, and names like Micron coming off a bit, remaining below their 50-day moving average after violating that moving average on Friday's session. Breadth data, not bad today, right? And so you have the New York Stock Exchange, 61% advancers versus 36% decliners. That's kind of pretty good bull market reading. On the S&P, 2-to-1 ratio of advancers versus decliners. Pretty consistently positive breadth across the equity landscape using these different universes. And so that's good, right? I mean, the breadth conditions not necessarily are going to track the movement in the indexes because the indexes are dominated by a couple growth sectors. But the breadth, I think, tells you the opportunity underneath the top line indexes, right? Are there enough stocks doing well? If breadth data remains strong, even if the S&P would start to break down, I mean, at best, it's kind of consolidating right now, but if it would break down, if breadth remains constructive, that means there's a lot of opportunities potentially to outperform a struggling benchmark. And that's what we've seen. That's what these strong breadth indicators recently, I think, have spoken to. Just to put a point on it, large cap growth, the only one of the 11 or the 9 Morningstar style boxes in the red. Best area to be was actually small cap growth. But other than that, kind of an opportunistic mix of things across cap tiers and across styles. The Dave Dirty Dozen basically hits on some of the key macro or the key stocks that we track in the growth space. Alphabet up 2.1%. That's the best performing name. That stock, of course, is one that we've highlighted after the gap lower after missed earnings last week. Thursday was the gap down. Friday chopping around. Today jumping up a bit, which is an encouraging start to the week. So obviously we want to see that built on as the week progresses. Microsoft looking more and more like a valid double bottom pattern, sort of rotating higher as well. And Apple has been the best chart of the bunch. Here's the problem, though. NVIDIA down 5%, Micron down 2.25%. No love for SpaceX. No love for Tesla. Tesla, of course, reported last week. We've got 4 of these names reporting earnings this week, and that between the Fed meeting and mega cap tech earnings and Mag 7 earnings, this is going to be a busy week of potential market catalysts. Again, I think this is that time when you sharpen your pencils and make sure that your risk management strategy is clearly defined. So stops should be updated to make sure we keep those ready to go. All right, let's continue on looking at the heat map here. As a reminder, we're live streaming on Facebook, YouTube, and X. Thank you guys so much. Those of you tuning in live, great to have you here as always as we break down the market action here on Monday, July 27th. If you're watching the show later on our YouTube channel, thank you so much for watching. I appreciate it. Any of you, drop questions in the live chat, drop questions in the comments section on our YouTube channel. We had a lot of fun with the mailbag episode on Friday. We're planning another mailbag episode this coming Friday. We love to feature your question on the show. All right, looking at the heat map here, so a couple things stand out. I mean, number one, I would say not a bad day, right? And we saw that the breadth indicators were generally positive. If you look across this quilt, right, this landscape, not bad. And I would say in particular sectors like consumer discretionary, consumer staples, both having generally good days. Financials, which remains sort of a key area of focus for us with some constructive charts looking pretty good. Even healthcare showing some signs of life after struggling a bit. Communication services, in a lot of places doing pretty well. So there, generally there's some really interesting places to be today. In the technology sector, excuse me, that's the second thing to talk about. Look at all the green in the technology sector. Now, it's not the semiconductor names. We're kind of rotating back to the software names. So names like ServiceNow and Adobe and Intuit and AppLovin and Salesforce. Have these been great charts? No. Are they good charts after today's rally? I would argue largely absolutely not. These are still stocks in primary downtrends compared to the primary uptrends we've been observing in semiconductors. But the way that this sector shifts, right, the way that leadership would rotate was the previous leading names in semiconductors like Micron, NVIDIA, AMD, KLAC, LRCX, all those charts start to rotate lower. The software names start to improve. And we saw hints of that earlier in the year, right? End of May, early June, we saw some signs that software is starting to improve, semiconductors starting to lag. Then it kind of went back and we saw semiconductors recover. We saw software struggle again. So this is just one day. I don't think it's I haven't seen enough evidence to say software is the play and we want to, be long software, short semiconductors. I haven't seen enough to really validate that as a well-defined thesis. But days like this definitely remind me that there's a mean reversion that might start to happen. And days like this also remind me that a chart like SanDisk can be, can lose a lot of value one day to the next. It's down another 11%. Again, I'm charts like SanDisk, the problem I have with charts like this, and I have other semiconductor names that I grabbed in a minute, but I mean, this is violating all of my kind of standard Dave Keller rules of managing risk, right? When you have a stock in a primary uptrend, we're above upward sloping moving averages. The price is above the 21-day EMA, the 21-day above the 50-day, the 50-day above the 200-day. Kind of mid-June is why, SanDisk, like classic bullish chart. I call that the moving averages in the proper order. It's a great chart. Now, everything that I just described, most of that has now changed, right? SanDisk broke below the 21-day EMA, which is often my initial level of risk, then broke below the 50-day moving average. Just in the last week and a half, we've traded back up to the 50-day and then failed and rotated lower. So it's still above the 200-day moving average. That's good. But the problem is it's been such a strong uptrend that the 200-day moving average is another 450 points below the current close. So, you could go all the way down to the 200-day, still be within a long-term bullish structure according to that moving average discipline, but you're losing a ton of value, right? And I think that's the problem with this space. We've already, and this is just a crude, check on the percentages, but we're down. Oh, I got rid of hold on. We're already down, 50% off the highs? That's not quite 45%, right? Just from the high in mid-June to where we're at. So we've already lost a ton of value. That's how big these swings are. So it looks like a very kind of normal environment. You have to remember that this uptrend is an accelerated uptrend with an aggressive slope. It's just moved so high for so long that became kind of normalized. So this looks like a little correction. This is a huge drop from 2,400 down to almost 1,200, right? So these are big swings. And unfortunately, the rise was such that this deterioration is really causing aggressive percentage moves to the downside. Chart of SanDisk is not a great chart anymore. I would say at best, it's an okay chart and probably less of one of those. So again, SanDisk, I would say very vulnerable. And I'm seeing a lot of charts like that in the semiconductor space. If you ask me, why are you not more optimistic about the markets? I would say the breakdown in those names is just too much. And I don't think that the major indexes can hold the levels that they've been in if names like SanDisk are deteriorating that aggressively. I might be wrong, but that's how I would generally describe it. Anything else on the heat map here before we continue on and look at some charts? I mean, the last thing I would say is that industrial sector remains a particular area of focus. When you look at the sectors with improving relative strength in the month of July, it's all the value sectors, right? It's financials, it's industrials, it's energy when crude oil prices have been strong, and it's the material sector. Those four sectors have all had pretty decent relative performance in the month of July. But I'm particularly looking at the defense names, right? Aerospace names, Raytheon, GE Aerospace, 3M, of course, is not. That's more of a conglomerate. But specifically that aerospace defense group kind of rotating higher, showing strength through the course of the month of July. All right, we're going to continue on in a few moments. And I apologize, I'm fighting a cold and I'm doing my best to keep my voice engaged. So thanks for hanging with me as I struggle a bit, but I'm doing okay. I do want to let you know I have a really fun live stream coming up this Thursday. We did a live stream with the portfolio managers from Tamara's Capital Management last month. It was very successful. We had some great feedback, so we wanted to do another one. We're entitling this one, How Professional Investors Build Systems That Survive Bear Markets. This could be an incredibly timely discussion with Vince Randazzo and Ryan Gorman talking about how they use a systematic approach to trend following and especially to managing risk. I think this will be a helpful session if you're concerned about what you're seeing in the markets, you're thinking about potential downside risk and how to management. We'll talk to some of the professionals about how they're doing it. No need to sign up. We're actually going to be live streaming that on our YouTube channel, on LinkedIn, on Facebook, and on X. So just make sure you subscribe to my YouTube channel. Make sure that you follow me on the socials and be able to check out that live stream. It'll be a lot of fun. We'll take questions live as we go, and I'd encourage you to check that out. Also, as a reminder, today, we are donating and encourage you to join me in supporting the Walden School. Go to marketmisbehavior.com/Walden. You can scan the QR code if you're live streaming on YouTube or watching the show later on our YouTube channel, should be a button to donate right from the YouTube platform. The Walden School is a really amazing group of people, group of musicians that every summer go up into the hills of New Hampshire and coach and support and encourage young musicians to explore, to experiment, to try different things, to compose, to create, and get up on stage and perform. And it is such a lovely place. It is a scenic spot, but also a wonderful place of making music. I have gone to the adult camp called the Creative Musicians Retreat a couple different times. I also serve on the board of the Walden School, and I believe deeply in their mission of creating safe spaces for people to learn and to create and to make music. I think we need the arts more than ever. And if you agree with me, I hope you will support the Walden School and join me in doing so today. Again, click the donate button if you're on YouTube and elsewhere. Just go to marketmisbehavior.com/Walden. Thanks so much for checking them out and for supporting music here. The arts need our help in 2026. All right, let's continue on looking at some charts together, shall we? So with all that choppiness today, at the end of the day, the S&P directionally did not really fluctuate a whole lot. Now, I would say that strong open being sold was pretty meaningful. So if there's one key takeaway on the chart of the S&P 500, I would say the fact that we opened above Thursday's and Friday's high was pretty interesting. The fact that we traded slightly higher out of that open and did get above the 50-day moving average, I think is interesting. The fact that we closed more toward the lows of the day, I think tells you a lot about a lack of support for today's strong open, right? If things are all bulled up and we should be optimistic, I would argue a strong open would be bought, and we see a lot of buyers coming in. We've been talking about a push back above the 50-day moving average. We got none of that today. We saw investors selling into that early strength. We're back mid-range of where we were on Thursday and Friday. So for me, sort of the overlying kind of tactical read is, earnings on Thursday. That was like Alphabet and Tesla on Wednesday after the close. Thursday's gap lower. We've just sort of been treading water down around that period. So we're still well within this consolidation phase. We do have a ton of earnings over the next 72 hours. Anything below 7,600 and above 7,300, I'm still thinking of as neutral. I'm thinking of that as a broader consolidation. For me, that tells me as a position trader, I just want to be patient. Market breaks above 7,600. I think that's a signal of much further gains potentially to come. Seasonally, when it's not necessarily the time where you would expect it, the trend is the trend. And if the momentum is positive, I want to follow that. What is a potentially more likely scenario, and one that I'm definitely sort of thinking through in my own brain, is what happens if we break below 7,300? What happens if we don't get the joy from those earnings this week? What happens if semiconductors continue to struggle and the strong breadth readings we're getting are just not enough to keep the S&P higher? I think an S&P below 7,300 is a huge warning sign. The VIX most likely spikes above 20 in that scenario. We'll see other confirmations of a bearish outcome. But for now, I'm thinking consolidation until further updates. Those are the levels that I'm watching. I think we have a clearly defined range right now. We'll keep watching it. But the last couple sessions, just lack of buyers, I think, is noticeable. Now, even though the S&P is holding support, even though the major benchmarks are sideways, and even though the technology sector is down again today, most stocks are still above key levels of support, right? We can see that in these indicators, which we call moving average breadth. 70% of the S&P 500 members finished the day above their 200-day moving average. That's pretty good. 69% of the S&P 500 members finished the day above their 50-day moving average. That's pretty good. When those indicators get below 50%, that's when I've learned to start getting concerned, because that would imply that not enough stocks are holding those key moving averages. When we've had an uptrend phase and now we've started to consolidate, as long as the breadth readings on this chart remain up in this level in the 60-70% range, that's just good. That's strength. And that tells you that just plenty of stocks are still in an uptrend according to that moving average methodology. This indicator at the bottom, which is the percent of stocks above their 50-day, that breaks below 50%. I think that would be a huge concern. And for me, that would tell me, watch out and be careful. But as long as we hold 50%, we're still in pretty good shape here. Other breadth indicators, and I should mention, by the way, I've got a new episode of my weekly show on Stock Charts TV that's not posted yet. Hopefully will be end of day today, maybe first thing tomorrow morning. But we talked particularly about market breadth indicators, go in detail through a couple of these. So I had these charts kind of worked up earlier and top of mind for me as I was preparing for the show. One of the things we've not necessarily seen, I would say, is enough stocks making new 52-week highs, a healthy bull market environment, which I'm hoping we get to. We need to see an expansion in new 52-week highs. We need to see more and more stocks breaking to new 52-week highs. Even if the S&P and the NASDAQ are not doing so, those early leadership names need to be driving higher. We're not seeing enough of that yet, but today about 6.5% of the S&P made a new 52-week high. That's on Monday, July 27th. That's not bad. And that's better than what we saw through the course of last week. Last week, it was around 3 to 4%. Today, more up to like 6, 7%. That's better. We want to see more and more. We want to get up to like 10, 12%. That would be a more healthy reading to be seen there. Healthy bull market needs an expansion to new highs. We're not seeing enough of that just yet. Hey, Hindenburg Omen time. I've got to bring this up yet again. We had a series of Hindenburg Omen signals back here in May and June. We made plenty of noise about that, and that is a kind of a what we call a composite indicator. It is an indicator called the Hindenburg Omen that is derived from other indicators, and it basically has 3 factors you're looking for. The market needs to be in an uptrend, which it still technically is. We need to have at least 2.5% of NYSE listings making a new 52-week high, and at least 2.5% making a new 52-week low on the same session. That actually happened on Friday. Over the weekend, we had the latest data polished up there, and that's what we can see, over 2.5% there on Friday. And then finally, the McClellan oscillator needs to be below 0, which tells you the short-term breadth, which is what the McClellan oscillator is. It's a short-term measure of breadth. That's slowed down a bit, and it's gone bearish. So all 3 factors were triggered as of last Friday. That means the clock starts. You got 30 days to signal again. And again, we've had a series of these signals that have fired over the last 12 months. We saw that in October and November of last year. We saw it again in February and March of this year, which I think was a really good leading indicator of that deterioration into the March low. We had them again in May and June, and now we're potentially having a revisiting of this Hindenburg Omen. So what does the Hindenburg Omen mean, right? Is it a, hey, we need to panic and sell everything indicator? No, I don't think so. For me, it's not as much of a great timing indicator. It's looking for a particular set of circumstances that happen usually over a 30-day calendar period. And when you see those combinations of different indicators, it tells me to be watching a key line in the sand, a key level of support, because the chances that we break that support are very, very elevated. So I see this as a warning siren going off. It's not telling me we're definitely going to crash, but it tells me that we're showing way too many similarities to previous major market tops. So something we'll continue to monitor here now going into the month of August. I would say most recently, we haven't made a new high since the Hindenburg Omen had a confirmed signal in late June. So for me, I think that's still a bearish omen for this market, but it's worth noting we're seeing that combination of factors yet again. The VIX not firing yet, right? And so I think, in an environment where things feel a bit unstable, which I would argue they do, mainly because of that weakness in growth stocks, are we seeing sort of like the big panic indicators? No. And I think one of my favorite and most widely followed, and certainly for me, what's been one of the most successful, is looking for a spike in volatility. When the options market starts pricing in bigger swings, that usually means you want to look out below for the S&P 500. We're kind of getting right up to that 20 level, but not quite closing above it. So for now, I would say still okay, but something we want to continue to watch. So the fact that the VIX isn't spiking yet is good. It's getting really close to 20, which is a problem. Crude oil prices surged higher last week on the latest headlines from the Middle East over the weekend. It sounds like another kind of pause in the fighting. And again, we're one headline away to crude oil spiking again. So this is going to be a volatile experience, which is what we've been, sort of anticipating and discussing. And it has not disappointed. We've had big daily swings. Today, crude oil prices down 8 to 10%, depending on what benchmark you're looking at. The U.S. benchmark, which we're showing here, crude oil future down to $82 a barrel. As we described it, right, anything above $80, I think, is something where people start talking and being concerned about elevated inflationary pressures. And we're seeing that certainly in the last week with a lot of discussions about potential inflationary pressures. We're going into the Fed meeting this week. So we'll see sort of what the latest thinking is in terms of the Fed's efforts or potential efforts to address inflation. But for now, crude oil prices coming back down. For now, $80 a barrel from a technical perspective, good level to watch. 75 is the 200-day moving average. That's a level we'd watch as well. In case you're wondering what's been happening on growth versus value, if you've been watching our show for a while, hopefully you're not surprised because we talk about that relationship often. And we often focus on, are we seeing strength in the growthy stuff like tech, in the more value-oriented stuff like financials and industrials, more defensive sectors? And one of the ways we can look at that rotation between different groups is looking at growth stocks versus value stocks. The top panel here is the Russell 1000 growth ETF versus the Russell 1000 value ETF. The bottom, it's the pure growth and pure value ETFs. And those are helpful because there are actually a lot of stocks that are considered both growth and value. More established growthy companies show, characteristics of both. So they're actually in both the value and growth indexes. So the pure growth ETFs basically look at the stocks that are not overlapping in that Venn diagram, just the ones that are purely growth or purely value. Both of them, I would say, deteriorating quite a bit here in the month of July. And again, speaking to me, telling me if I've been all overweight growth, and this is something we've talked about for a while. Hopefully this is not a surprise at this particular moment, but if you've been all growthed up, I get it when those stocks are outperforming. But when value starts to dominate, that's when you want to start looking and diversifying into other areas. Financials has been a top area of focus for us. But, again, we're seeing more and more emerging strength, even in consumer staples this week. All right. So from individual names, right? So I would say another thing that makes me skeptical about a big breakout for the S&P and the NASDAQ, if we're gonna be all breaking out and stuff, I would expect NVIDIA to be powering above 215 and giving me all sorts of optimism about future upside. Today, NVIDIA was down 5%. So instead of us talking about a completed inverted head and shoulders, reversal pattern and upside to retest the previous all-time highs, instead of that, we're talking about the 200-day moving average, which is just a couple points away. We're talking about the June and July swing lows around 190, 191, which is not too far away. There's also a major Fibonacci support level. So we've got a confluence of support in the 190 to 193 range right about now, which means as long as that holds, NVIDIA is okay. If that does not hold, NVIDIA is very much not okay. And I would say breakdowns on charts like NVIDIA just speak to a lack of optimism on the AI trade. And unfortunately, at some point, weakness in NVIDIA really starts to proliferate, and you see weakness in other areas as well. Costco, good news. Costco is retesting the 200-day moving average. The bad news is it's had a couple opportunities to retest and recover the 200-day moving average going back to the end of June. It's failed to do so in all those previous occurrences. So color me a little bit skeptical that this is finally going to do it, but I think we want to watch and see if Costco can gain a foothold above the 200-day, if the RSI can push above 60. I think this could be a really interesting chart. I wanted to highlight, by the way, the MACD indicator. This is actually the PPO indicator, the percent price oscillator. It's like the MACD indicator, but it uses percentages instead of dollar amounts, but very similar to the MACD. Classic buy signal for the MACD indicator is you go well below zero and the MACD line or the PPO line crosses up through the red signal line. I just want to notice we had a false positive there in mid-June, never really spread out at all. We had another kind of quick buy signal in July that went back to bearish 2 days later. And now we once again had a bullish crossover. This one looks like it's starting to hold a little bit here. And so we're kind of having a very similar pattern to what we saw here in December of last year, kind of the new low, higher low, break above the 21-day, break above the 50-day, bullish crossover here at the bottom. And we can see that we start to improve. And the RSI getting above 60, I would argue, was kind of that final signal that we were seeing positive momentum. Now, we've seen some similar things. We've seen the higher low like we did at the beginning of this year. We've seen the MACD buy signal. We've regained the 21-day EMA. Now we need to get above the rest of these moving averages, but I would also say the RSI above 60 is one of those great all clear signals actually after you've had a downtrend. So really, really close, I would say, to completing an upside rotation in Costco. Not quite there, but something certainly that we'll be watching. All right, two more charts, and then we'll take a question or two before we finish off. Philip Morris making a new 52-week closing high today. We're looking at the unadjusted version of this chart. On higher yielding names, by the way, we like to use the unadjusted data. And as a quick tutorial, every charting platform does this a little bit differently. On stock charts, which is one of the ones that I use, there's this little selection below the chart that says adjust for dividends. For most charts, that kind of works pretty well. But for a higher yielding name like Philip Morris, right, with a dividend yield above 3%, we want to look at the unadjusted data. And what that does, it kind of just takes the dividend adjustments off, which gives me a clearer read into the price action. And what we can see here is the February peak and the May peak lined up very well. That lines up pretty well with where we've been the last week or two. And it certainly looks like we were resolving this pattern to the upside, which I think is pretty encouraging. Let's see if the RSI can drift higher as well. But I think Philip Morris could be a pretty interesting setup right about here. Finally, American Airlines Group. I just want to highlight that, transportation names have been kind of mixed, to be honest with you. And airlines have been mixed as well. But AAL stands out after bouncing off of the 200-day moving average. They reported earnings last week, bounced off the 200-day and a key Fibonacci level. Friday had that nice bounce. Today, we're kind of continuing higher. So I like that bounce off of the 200-day. For me, clearly defined risk level down here around 13 and a half. As long as we hold that, I think that's a pretty interesting potential contrary play, playing a reversion back to retest some of those previous highs. All right, we'll take a question or two. Hey, I love this observation, by the way. Smoking is up. How about drinking stocks? That is referring to one of my favorite quotes, the late Alan Shaw, who was a legendary technical analyst. He was like a couple generations before me. He was a mentor of Luis Yamada and Ralph Acampora, who was one of my mentors. And he would say, when the going gets tough, the tough get eating, smoking, and drinking. Always be concerned when names like tobacco names, alcohol, beverages, these are, staples, right? These are the things that, regardless of the economic environment, you're probably going to still spend money on those things. And that's why those charts showing strength, 100% agree with you. For me, that's little sort of, little spidey sense goes off going, ooh, how good is it that Philip Morris is breaking out, right? So always an interesting reminder, the consumer staple sector, particularly the food, tobacco, alcohol names, always important to watch. And I would totally agree. Not all of them look as good as Philip Morris right now, but a number of them starting to pop higher a little bit. Right angle triangle. I like small cap value better than the Russell 2000. I had a really good interview on the podcast recently, which I hope you guys have caught. Chris Tesson. This is not last week, the week before. Chris Tesson's a portfolio manager at Acuitas Investments, based here in the Seattle area. He's a small and micro cap fund manager. We had a really good discussion. Not all small cap is created equal. And I would certainly say, if you're able to sort of think about it, thinking about the different areas of the small cap space, 100% agreed. In the small cap indexes, by the way, in the Russell 2000, you have to remember that growth is not as much of an overweight, right? That is sort of a large cap issue with our U.S. benchmarks. The S&P and the NASDAQ are, the NASDAQ for sure, almost all growth. The S&P 500, heavily weighted into the growth sectors like technology. The small cap index is a little less so, right? So there's a lot more of a value tilt there. So part of the story, I would say, with small caps doing so well is the fact that value is outperforming growth, certainly in the month of July. And so I think that is certainly a part of it. Let's see. One other comment here. And it's some of the regulars dropping some great comments here. Thank you guys, as always, for making the show interesting and weighing in. The VIX, the credit spread, and breadth, Keller's triad. I don't know if I've ever called it that, but that's not bad, right? When you think about the warning signs, right? And these are just things, it's funny. These are things that I've learned from previous market tops and kind of weathering through, in early in my career. I think this is the way that you learn as an investor. Early in my career, the market would top and I'd be like, what the hell just happened? And I would talk to clients of mine and say, like, what did you see? And I was like, the first time I was like, I looked at the VIX spike. That tells you things are getting worse. I was like, oh, tell me more about this VIX thing. And I kind of, studied more about it. Credit spreads, I learned that a lot from working with the fixed income team at Fidelity. We had the high yield portfolio managers and analysts right down the hall from us in Boston. So I would love to go down there and hear how they were thinking about it. And they always were so more well attuned to risk measures than the equity managers were, right? A lot of our equity managers were more growth oriented. So they were all thinking about potential returns. They were thinking about potential upside. The bond investors were thinking about potential downside. They were thinking about risks and thinking about companies being unable to pay their debt payments. And so credit spreads have been such a great leading indicator over my career of when bond investors are recognizing some weakness. So I don't think that's bad. Keller's triad, I might have to trademark that one. I think that's a pretty good one. So, to be clear for now, right? None of those. I mean, I would say breadth kind of neutral, right? Some of the breadth indicators getting a little more negative, but some of them still okay. Credit spread's still fine, VIX still fine, but really, really close, right? We're not too far off from a spike in the VIX. We've been teasing the level. Credit spreads are still pretty narrow, but those are the warning signs to watch for now, because as the market's holding up, those are the early warning signs, often after a major top, that something's starting to get a little more ugly. Great comments today, guys, and thanks so much for watching. By the way, if you're watching the show later on our YouTube channel, thank you for dropping questions in the comment section. We'd love to hear from you. As a reminder, just one final comment. Today is Giving Day for a cause that I support. Is very near and dear to my heart, called the Walden School. This is known as the summer music camp that changes lives. I've attended a couple times. I've composed music. I've played trumpet. I've sung. I've met other awesome musicians from around the world. It is a wonderful place. And I feel like in 2026, when it feels like society is fractured, if you feel disillusioned that people are good, this is one of those places where there are good people making music and just remind you of how wonderful it is to be a part of a supportive community. So please, if you could, click on the donate button or go to marketmisbehavior.com/Walden and check it out. I know they'd appreciate you guys checking out their programs. And if you have musicians in your lives, please let them know about the Walden School. I'd love to get some other great musicians up there as well. That'll do it for today. My name's Dave Keller with Market Misbehavior, reminding you it is always a good time to own good charts. Thanks so much. Take care.